Directly from 42nd Street in Midtown Manhattan, New York. I am your host Harbin and you're watching my channel YOLO. You only live once.
Let's talk about today's topic. I received a question from a subscriber. Thanks, Umesh, for your question. The question was that if you can show how to build 3 retirement buckets for cash during the year, for 2 to 5 year bucket using bond ladder, and the third bucket, long term, consisting of stocks for growth. For a $2.5 million total asset, how to build the second bucket of bond and treasury ladder so as to withdraw 4% of 2.5 million. That means around 100K from the first bucket of cash for daily use. Thanks. It's a very good question, and I do have a video on what we mean by a multiple bucket strategy, where I actually explain different kind of buckets. Since we don't know the origin of this total portfolio, so whether this total portfolio is in retirement, or it's in a non-taxable account, or it's in tax-free account, or a tax-deferred account. So as you see in my multiple bucket strategy, I have explained that, okay, the buckets based on tax status. So that means a taxable bucket, a tax deferred bucket, and the tax-free bucket. Okay, so for this exercise, since we don't know exactly which bucket this total retirement account is, so I will consider it as a mix of taxable and a tax deferred, which is normally the case for majority of the people. So let's assume that, and let's take that as an assumption and build the portfolio of $2.5 million, where the requirement is 100,000 to be spent every year. So if that's the question we have, let's first basically put money into 3 different accounts. So that means we put low risk. Okay, so that means where the money we want to use for the year should be in a low risk. So that means in the low risk bucket, we have 1 year of money. In the medium risk, we should have 2 to 5 years of money. And in the high risk, we should have rest of the money. Now, when we actually say low risk, we are talking about, we can actually say high yield saving accounts, the T-bills, treasury bills. You can actually have in checking and saving accounts. You can have CDs. They are all considered as a low risk investment. When we are talking about medium risk, we are basically saying risk based on the interest. It is still should be safer. So we want to basically put in treasury bonds or similar. Basically, you can put it in corporation bond, munis bond, those type of where the risk is of mostly of the interest risk, not of default risk. So basically, we don't want default risk during this bucket. We want most of our interest rate. That means you actually put it for one particular interest and the inflation is high, and then you are actually getting a lower money value than you would have anticipated if you actually invested in a higher rate. So in the high risk, we are saying that, okay, we are putting it for growth stocks, or we are putting it for dividend stocks, but based on which one you want to actually say, we will actually add it accordingly. Now, again, when it is a taxable account, we say that we want to basically make sure that we minimize the cash or the cash equivalent in a bucket where you will be taxed as an ordinary income. Because if you're taxed as an ordinary income, you are basically losing money to your taxes. Okay, you should better off either having a capital gains or at least having state and local tax exempt if you're staying in a high tax state. If you're staying in a state where there is no state income tax or local tax, then you there is no difference between you getting the cash or putting the cash in ordinary income bucket or in the state and local tax exempt bucket. So taking that into consideration, let's look at how we would like to distribute money in our three buckets. The risk here, 2 to 5 year, is not of, you should not actually have a default risk. Okay. If you are putting yourself to default risk by actually getting a higher interest rate, then the risk become of default risk. Here we are just saying that medium risk with respect to the interest rate. Okay. So that means in 2 to 5 years, the inflation goes high, then the value of your money returned will be lower than the value of the money you would have uh, gotten if you have invested it on a higher interest rate. So let's look at how the distribution should be. We wanted 100,000 in the first year. So we are saying that, okay, since you're investing 100,000, that means your requirement is around 10 to 12,000 every month. So you should have 10 to 12,000 in actually checking or a high yield saving account where you can actually withdraw it. Then in 1 month, you actually have 8,000, because if you divide 100,000 by 12, you get 8,000 something back. So that means your spending is around $8,000 to $9,000 every month. So you should have 8,000 maturing every month. Okay, till the next 6 months or so. So once you have that taken care of in the week of 17, so basically because we have a 24 week of 24 also, so that's why we have 16,000 in the week of 17 maturing. Then at the end of 6 months, we have 48,000 maturing, because that 48,000 you at the end of 6 months you will actually reinvest in this support 8, 13, 17, and 26. So that cycle continues with this $48,000, and then in the 52 weeks one, you will invest this thing once this mature into these 1 to 7 again for the next year. Again, when you will come to the 2 years mark, you have 200,000. So you invest 100,000 for 1 year. So that means 52 weeks, and 100,000 goes into these 1 to 7. So that goes on with subsequent years. What will happen in the subsequent years? You are actually going to time the market. So that means you will look for like, okay, if the market is high, you basically liquid some from growth stocks or dividend stock. Most likely, I will prefer you take 50% from dividend and 50% from growth stocks. That means, so if you have a 22,000 dividend income, then if you think you have 100,000 generated actually without losing any value of the portfolio. And that's our goal. Some year you will realize this goal, and some year you will not be able to realize this goal. So that means some year your dividend stock will be 22,000, or some year you might not get 22,000. Some year you might actually see more bond interest, okay, generated, and some year you will see less bond interest generated. Okay, but some year you might have more growth than 4% in your growth stock or in your dividend stock, while basically we are saying that you are withdrawing from these. But the goal is to actually have 100,000 withdraw in this fashion. The point is that you have, if you look at what's our distribution, we have a cash only less than 1% in our cash. We have T-bills almost 8%. We have treasury bonds, which are 32%. So total of this is around 40%. So if you are in the early age of your retirement, this is a good distribution. You have 40% in your bonds, you have 20% in your dividend stocks, and you have 40% in your growth stocks portfolio. So it's actually still be considered at 40-60 distribution. That means 40% in bond and 60% in stock. As and when you basically are going into your retirement, as we have told you that, okay, every year you are moving 100,000 from this dividend and growth stocks back into your bonds and the 5-year bonds. Those 5-year bonds get this 100,000 is coming from these two portfolios. So every year you are moving 100,000 from these two portfolio into your treasury bond 5-year. Okay. That takes into account that, okay, it might be that, okay, you have got 40% from this one, 40,000 from this thing and 22 here. But what we are trying to say that you are actually taking maybe if 60,000 from here and 40,000 from here. Okay, depending on how you want to basically take. So you can actually have in the same ratio. Okay, so that means you take around 60-40. So you think 60,000 here and the 40,000 here. Okay, or you're taking basically 35,000 here, or actually 33,000 here and 66,000 here. So you are actually taking in 2:1 ratio. So twice 2 ratio here and 1 ratio here. So you take 66,000 from your growth stocks and 33,000 from your 500 and then push that into a 5-year bond. So every year your ratio will actually change. You will have more in the bond side and then less in the dividend growth, depending on if this is going to basically keep circulating as 2.5 million. If you are able to actually generate 100,000 portfolio income from this portfolio, you will always be in this ratio. But if you're unable to generate 100,000 from this portfolio, your ratio of bonds should go up and your ratio of stocks should go down as the year progress. So as the year progress, if your portfolio is not generated 100,000, you will see your bond ratio should actually be higher than 40% and your stock ratios should be lower than 60%. But this is the max case. Okay, so if your portfolio is generating 100,000, you will be in this ratio and will never run out of the money. You will always be basically generating or taking that 100,000 from the portfolio without losing any value going forward. So that's the goal. It's actually a very good distribution. If the distribution was done a month back in October, I would have advised that dividend stock of 500,000 could have been invested again in long-term bonds and to lock in more than 4% of value interest. So that means in October, the long-term 20 years, if you look at my treasury bond laddering in my taxable and retirement accounts, rollover IRA, you'll see I have used strips. So if the amount here had been in the retirement account, then I would have preferred put in strips and have better leverage on that 15 to 20 year time frame, and you can actually easily double your money in that time frame with those strips. But now you can still wait for the time, so wait for the opportune time in 2023 if interest on that treasury bond goes high above 4% for long term, you might be able to lock in that and actually move some of the dividend or the growth stock money into that. So that's where you distribute on that of between 5 to 15 years of time frame. Up to 20, you can actually play with that number depending on where it lands, because if you are locking in more than 4% there, so your portfolio, your need is 4%, so you're locking in that long-term 4% return from your portfolio. That means you will be able to actually withdraw 100,000 without risk of losing your portfolio at all. With the dividend stock and growth stock, you still need to basically time it when you want to sell it. In the years when the stock portfolio are going down, you should not touch them. You should let them come back, and when they come back, you basically distribute money from that. Because if you look at it, you are taken care of by this portfolio for at least 15 years before you actually have to touch your growth stocks or dividend stocks. But that doesn't mean you have to actually not touch those things for 15 years. Every year you will want to basically distribute money out of it, and to make sure that basically you're not uh, making the balance in the portfolio skewed towards stocks. So it should not happen that 2 years from now you have more than 60% in your stock portfolio than in your bond portfolio. You should actually try to keep this 40-60 balance, uh, as long as your portfolio is generating more than 100,000. If your portfolio stop generating 100,000, you should be more in the bond than in the stocks. Okay, and then you don't actually need to recalibrate at that point, and you have to let the stock portfolio come back before you actually start withdrawing from the stock portfolio. I hope this helps you, Umesh, to create your portfolio on the similar line. So let's look at this portfolio from where the money is. If you want to basically create this portfolio with the money in both taxable and tax deferred account, I will actually ask you to create your growth portfolio in the tax deferred account. So that means the stock portfolio should go to your tax deferred account, and your bond portfolio should go to your taxable account. If you don't have this, basically assume you have equal taxable and equal tax deferred account. If you don't have equal taxable and tax deferred account, I will still advise you that you have all the growth stocks, the both dividend and growth stock in your tax deferred account, and then you have the bonds, okay, to be like long-term bonds in the tax deferred account, and then actually you should use strips instead of T-bonds in your tax deferred account, while in the taxable account you should use T-bond, treasury bonds. Don't use strips in the taxable account. So that's the distribution or way you will create, whether it's the money is in a taxable account or money is in a tax deferred account. I hope that clarifies how to basically build a portfolio with 2.5 million assets distributed among the taxable or the tax deferred account, and how to withdraw from it, how to ladder your treasury bonds in your middle 2 to 5 years, and how to recirculate that to keep the portfolio value coming out of it as 100,000.